the great thing about multifamily is that as you continue adding units and growing, you start realizing that the smaller ones become more of a pain to deal with than the bigger ones. I'll tell you guys, I'm telling you right now, when I first started in this thing, I would have said, you're crazy. I would have said, know what? You're nuts. Forget it. There's no way. No, I'm telling you, I promise you, the bigger deals are way easier, way less risky, because it only takes one thing on a 22 unit to go sideways and you're out for the rest of the year. Like a boiler goes out on a 22 unit. I know, I'll tell you what, I got something that just happened the other day. So I have a 22 unit deal, another 22 unit deal. The water tank blows out. Get a quote, $12,000 for a water tank. Now the water tank that was in this thing was a commercial water tank, right? Meanwhile, I have a 126 unit deal. It has a very similar water tank. There's two of them though, right? For 126 high rise, right? So I have a 126 unit high rise and a 22 unit. They both have very similar water tanks. I blew out a water tank in that one too. It was $12,000. The difference is my 126 unit deal makes $100,000 a month. And I'll be lucky if my 22 unit does $100,000 in 2 years. So that's the point. It's like, it only takes one thing to go sideways. Next thing you know, you're having to scramble to try to figure out how to fix a water tank, and I don't like dealing with stuff like that personally. There's other things to do. I'd rather scale my business and raise money and do stuff like that and work deals than to try to chase down contractors for water tanks and stuff. Right. So anyway, that's my long-winded introduction. So, all right. Hey, Mark, you there? Mark?
Yeah. Hello.
Hey, Mark. I don't see your face, but I don't know if your name sounds familiar. Have you been on before? Have you been here before?
No, you can thank Scott for that. I spoke to Scott was it last week or earlier this week, and he said, hey, come out to the meeting on Saturday, and here I am.
Awesome. Cool. Well, welcome. I'd love to spend a little bit of time getting to know you before I introduce you to Roberta. Tell me which do you have any multifamily now? Like what's your background?
Yeah, so I'm located in upstate New York,
okay.
in a city called Binghamton. I don't know if anyone's heard of Binghamton, but closest city you know by name is Syracuse, which is about an hour away. We're in a college town. I own about 140 units here. I rent to about 300 college students, and then we have about 25 market rate apartments in that portfolio.
Nice.
To do more and grow, Northeast Ohio is a drive away. So we're kind of looking there just because planes are going to be a little difficult here in the short run.
Yeah.
So just trying to kind of grow and see where else we can go and find some local partners maybe to help us really, get some boots on the ground and kind of move forward.
Yeah. Excellent. Well, it's funny that 200 unit deal, it's owned by a very large REIT, like a huge company. I can't disclose yet. Once I get it under contract, I'm happy to share all kinds of details, but we own the property like right next door, a high rise and right next door. Their unit is their buildings have two high rises. They're a complete disaster. They come over to ours. We didn't know that they came over to our side, and they look at how we run our stuff, and they look around like, holy crap! If these guys could do the same thing over here, we want to send them more deals. We want them to run all of this stuff in Ohio. So they're out of I think they're out of New York City, right? So yeah, a lot of opportunity for that. So absolutely, yeah. Because trying to run this stuff remotely is hell. I think that's what most people underestimate is that trying to find a good operator locally is always very, very difficult. So that's why I only focus on Ohio. So anyway, all right, well, good. Thanks for coming out. Paula, what are you up to? I'm just putting people on the spot. It's all right, Frank. There's Paula. How are you?
Yes, here I am. Sorry, I didn't know I was going to be actually on, so that's why I didn't have my video on. Right. I'm actually brand new to the whole investing thing, so I'm just here to try to learn anything I can. I actually just bought my first duplex.
Awesome.
So I am way down here.
Hey, believe it or not, Paula, I'll tell you, there's so many people. I've been doing this for a little while now, and we do our live meetups. Obviously, given the current circumstances, this is how we live today. But you know what, though, the really cool thing is that we're able to quickly get on, still meet each other. We do the Brady Bunch thing. I get really cool guests to come out, and you get to learn something. So it's great. But many of the people that come out to our live events, anyway, they don't do anything for years. Like, actually, I've known Scott for many years. They would come out to our events. Scott, how many people have said, "Oh yeah, someday I'll buy something," and then years later they still haven't done anything? So at least, Paul, at least you've done something. That's awesome. That's great. Now you gotta, but now multiply that by 10.
Yeah.
That's next.
Well, I think that, yeah, there's a little fear factor there still. So
yeah. What would you say is your biggest fear?
Well, just sort of like the leveraging, so getting into more debt, buying something bigger. Yeah. So.
Yeah. So I don't subscribe to the Dave Ramsey thing. Debt, in this case, debt is good. That is very good. But the key is you have to underwrite properly. You have to know the deals you're getting into, right? That's the key. And again, I'm not railing on Dave Ramsey. I actually listened to some of his stuff, and I think that his program, his mantra is written for the majority of Americans that have not had the financial education. So he's teaching them how to live within your means. That's his thing. And these are the people that may or may not be interested in actually investing in anything. They just want to live their life, work 40 hours, and that's it. So I'm not going to hate on the guy. He's delivering a product that people want to hear so they can just live their lives, and they'll be on the struggle bus forever. That's what's up with them, right? But I think for everyone on this Zoom meeting right now, we all want to have financial freedom, and real estate is, I'm telling you, by far the only way to do it. I don't know of a single way, and I've done a lot of stuff I don't even want to talk about. It's just ridiculous, right? But I've lost thousands of dollars doing dumb stuff. And, this is the only thing where you can roll into a bank and the bank will give you 75% of the money to go buy a cash flowing deal. They'll never do that for your hair salon. They'll never do that for your mobile app, right, Scott? They won't do that for your mobile app, but they'll give you $1 million to go buy a cash flowing property. They'll do that. They'll do it twice, So, yeah, it's awesome. It's all well. Good. Welcome. Thanks for coming out. I appreciate it. All right. I don't see any names on mine, so of course I know Frank. Frank, how you doing, bud? You doing all right?
Good. How you doing this morning? How's everybody doing today?
Good.
Awesome. Good. Well, let's see. And then Zachary, you're a new face, right? I don't think I met you before, right?
No, yeah, I'm new. I kind of come in. I own. Currently, I rent. I've got 6 properties in the Akron area, kind of scattered about. There's all single-family dwellings, and I'm doing pretty well at that, and I'm looking to scale up. So when I got the information about this through the SCREIA group, decided that I would kind of log on here because I want to start networking, and I want to scale up. I want to get. I am looking for that financial freedom. I've got I think a pretty solid foundation built and a name built with my company, and am looking to expand into multifamily. I've been reading a lot of books about how to leverage properties and how to buy low and fix up and sell and all that stuff. So yeah, just kind of working through that process and looking to network with some people and think through how to do that, how to scale up. So that's where I'm at.
Awesome. Good. And Yvette, we've met before somewhere, right?
I think so.
Yeah.
It's been a while ago, but yes. I have been a landlord in the past, just with one single family home. And unfortunately through divorce, I wasn't able to keep that property, but I do want to. I'm just now getting back into this process, and I think I would prefer to do multifamily over single family, which is one reason why I'm in this program today, just to learn a little bit more about how to get into it, things that would need to be done. And I'm hoping to have my first property within the next few months.
Good. Excellent. 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 And of course, Craig and I go back a long ways, right, bud? No, you're muted, man. You're muted. There you go.
Morning.
How you doing, man? Doing all right? It's been a little bit.
A little buying, a little selling, you know.
Excellent, excellent, excellent. Well, I think, you know, for those that are starting out, I think Craig will tell you too, you know, always go bigger, right? It's those are way easier to manage, right?
They are. The bigger the better. Usually, if it's there is a market though, I think, for the 20 to 50 units, just because the bigger guys aren't fishing there, and the everyday duplex guy isn't fishing there either. So you know, you'll find some sweet deals in the 20 to 50 range, but the 100, you know, it's hard to beat the financing you get on the ones over $1 million.
Yeah. Well, you know what, though, the key first of all is just getting started. That's the thing, you know. So I have a coaching program that I'm probably going to be ratcheting down, but for the time being, we're still operating it. Once I close on, I'm buying a very, very large historical property in downtown Cleveland. It's going to be 110 million when it's completed. It's a big deal. When that one rolls out, I'm going to be busy with that. So next month we're closing that. It's going to keep me very, very busy. Plus these other units I was telling you about before. So, but in the meantime, if you're ever interested in learning like one-on-one coaching, let me know. And then we're doing something with Connie. I think in a couple of weeks, we're going to be doing a webinar on raising capital. Like this is going to be a very, very specific, I guess you want to call it like a webinar on raising money, like the big guys do, right? This isn't going to be something like a small player type scenario. So that's coming up too. So you'll hear about that. But in the meantime, though, one of the things that I wanted to address for today, and this is why I have Roberta on with the iPlan group, many people aren't aware of where to get cash, where to get money. Right. So if, let's say, for instance, Yvette wants to raise money right now for a deal, right, or get her hands on some cash to fund, say, a 10 unit. Mm-hmm. Most people don't know that they can use their 401ks. They can use a self-directed IRA to make that deal happen. They just don't know. Right. I mean, when I started, I didn't know. I had to learn all this on my own. Right. I didn't have a mentor or anything else like that. I was reading books. I heard about it on some program, and next thing you know, someone says, "Oh yeah, you can do a self-directed IRA." And does anybody here know what a self-directed IRA is? Has anybody heard of this before? Yeah. Okay. Good. So what's funny is that I had no idea. I was a corporate guy. I was a C-level guy. I had no idea that was even a thing. Ridiculous. If I would have known, my life would have been completely different. I had so much money trapped in that thing, and all my friends had money trapped in that thing. None of us knew anything about this stuff, right? So Roberta, I've known Roberta for years at this point, and when she was telling me about some of the things that you could do with these self-directed IRAs, even as recently as the other day, some of the things that she knows about this stuff is just really cool. So I want to bring it to the group and really have her share some of her experiences. She's worked for some other big names here locally, and now she's with iPlan, and iPlan's a great group as well. So Roberta, if you want to maybe tell everyone about yourself and what you guys do.
Sure, thank you. I do have some slides to share, so I'll probably interject that as we go. But again, thank you for having me, Agostino, and congratulations on your continued success. Every time I listen to you, the excitement and the progression of from the time that I've known you, it's just really, it's contagious, your inspiration. So
thank you.
I always love being a part of your groups, and also for the beginners as well as the experienced. investors, very welcoming. So I think that's very important. We have the same mindset at iPlan Group, and we're actually located in Westlake, just outside of Cleveland, obviously, on the west side. We are a national company, but we do have a nice local presence. And I'm going to talk a little bit about, who we are, Self-Directed IRA administrator. We have a custodial responsibility for people that are using retirement dollars, 401k, those kinds of things, to invest into alternatives. And of course, our focus here today primarily is real estate, but we're going to kind of cover the basics, nuts and bolts. I saw some people nodding and saying, yes, I've heard of self-directed IRAs. Maybe verbally, if anybody could just say, please, are you using a self-directed IRA? Anybody just verbally, yes, or?
Yeah, I am, yeah.
No.
Oh, yeah. Yeah.
Yes.
No.
So we have about maybe three or four people that said yes. Okay, great. So I don't want to be redundant, but I also want to just kind of cover basics. There might be some things that you are already doing, but I'll go through that first and then just keep this really focused on you and the questions that you have. The capital resources, that focus, IRAs definitely are a pool, right, of capital resources. And there's different regulations that I'm not going to cover today about private money lending. That's a whole topic in and of itself. And it sounds like Connie's going to really cover that very well in a couple of weeks. And I encourage you to join that, because there's definitely things you need to know about raising capital and private money and what does that look like. Our conversation is a little bit more from an education. So here's what a self-directed IRA is. This is how I'm using it or can use it. We're going to talk about when you pay taxes, when you don't, right? Sometimes you don't. And then you might have some questions on just some of those basics, or maybe a little aha moment. There's also some regulation that has come out, the quarantine and the different things we're experiencing here right now across the country. We're hearing a lot of different I want to say comments, theories, right? But the bottom line is the government has provided the CARES Act, which is part of the Stimulus Act. We'll touch on that. There's some things as an IRA holder that you're going to want to know. But as an investor, your mindset, of course, is always different, right? You weather the storms and you're not dependent upon what the government's saying or your neighbor's saying or the family or the naysayer, right? You know what the tools are, and you are able to get yourself connected, educated, and you stay consistent with the plan and with the tools. I love self-directed IRA conversation because it is giving you a tool to add to the toolkit that maybe Agostino has provided you and other mentors or people that you have. So it's another tool that you're adding in there. It's not your silver bullet. It's the thing that you're going to add to develop some tax deferred and possibly some tax-free income, and also attract investors. So that's what I want to focus on today. I'm going to share my screen and just kind of walk through what I normally do cover. But again, I'll probably go through it a little bit quick to keep it interesting. If you do have questions, jot those down. And if you want to interrupt me at any time, Agostino, and go ahead and address a question, I should say, we can certainly do that.
No, I'm just going to interrupt you.
Okay.
I'm not going to address any questions.
And let me get started here. Just from the top. Okay, yep, we have 3 seconds in there today. So I already welcomed you. iPlan Group, located in Westlake, Ohio, national company. Self-directed IRA administrator with the custodial responsibility for those of you account holders that are using retirement dollars for alternative investments. And of course, our focus here today is with you on multifamily. So I want you to be thinking about those concepts as we talk. Very important, of course, that we do the disclaimer and the housekeeping about what our role is here today, and it is just for educational purposes only. We do not give you any tax, legal, investment advice. I do not call Agostino the hero and give you any direction that you, I might call him a hero, but I'm not going to endorse any particular investment, not our role. What's very important for you to know, however, is when you use a retirement account or you refer somebody to us that might be one of your investors, we are going to do what we call a compliance review. So we're regulated by the Department of Labor and the IRS. So there's things that are permissible with an IRA, self-directed IRA, and there's some things that are not. So we're going to collect all that paperwork behind that investment to make sure that it's compliant. So, but our goal here today is just education. That is one of the ways that we bring dynamic networking events, even online or offline, but we do that through education. But we're not a fiduciary. We're not going to give you that investment advice. Very important you talk with your real estate attorneys specific to the state that you're investing in, I would mention. Doing your due diligence through CPAs and all the parties involved in your investment. I already talked about kind of what we're gonna cover. Why now? If you have not used this concept before, there might be some reasons to look at it now because, again, it's growing. Self-directed IRAs are becoming more popular than they used to be. It's important to know, too, all the different accounts that can be used. There's specialty accounts, we'll cover that. And, of course, just how to learn more with us and how to get started. As Agostino already mentioned, getting started is probably, the most important thing. What we really do at iPlan Group is really empower our clients to do self-directed IRA investing. We give them the resources, we give them the education, and enable them to do things outside of the stock market. That's really the key. We are owned and we're founded by Jill Banner. She's our CEO founder, and she's a very accomplished real estate investor. So with that mindset, that's how iPlan came about. She has done everything from mobile home parks, mineral rights, land, wholesaling, auctions. She's done a lot in the tax deed, lien, distressed property. And with that mindset, of course, all of us at iPlan Group, we are self-directed IRA investors. So we have this mindset. And she was a client of a very large firm here in Northeast Ohio, self-directed IRA company, and just got frustrated, basically. So when you're doing an auction or a wholesale deal, or you're putting something together quickly, which you need to do a lot as a real estate investor, you need the funds to the table. So with a self-directed IRA, it's a different process. What we do is same-day processing, enabling our clients to get the deals done more quickly and move on to the next one. We have a personal client experience. We actually answer the phone. I kind of smile when I say that, but we do. And you don't get lost in a phone queue. So you don't pay extra either for these things. So very simplified fee structure. Self-directed, this again, basic. Self-directed IRA. Self-directing is just an industry term. All that it means is that you hold a portion of your retirement dollars with a company like an iPlan Group that allows you to say where you're going to direct those funds, what you're going to invest in, alternatives. Primarily real estate, I think, is what we hear the most, but you can do private companies, entities, and private lending, and we'll touch on that. In terms of the contribution limit and the distribution rules, this IRA is exactly the same as the one that you might hold right now. Again, self-directed, just an industry term. You've got it with a company like us that says you can direct it. Why are people doing it? It's for investment diversification. That's probably the biggest one. People want to invest in what they know, what they're comfortable with. Like some of you that shared today, you've talked about single family homes, you've talked about multifamily, whether that's a small property or large, it's what you're comfortable with. That you know that's where you're winning. So we're just adding a tool with self-directed IRAs to do it in a tax advantaged way, potentially tax-free, and that's the Roth conversation. Unlimited growth, by the way, when you use a self-directed IRA, there's no limit. You can deploy those funds over and over and over, return them back to your IRA, and grow it continually. I like to share this story because it is a powerful one in multifamily in a different aspect, I guess you could say, right? Multiple properties. But Larry retired from Ford, and he was very happy to retire when he did, except his pension, the shares in his pension were $75 each per share valued. But when he retired, it was just $3, not exactly an exciting. It was very difficult. However, he's a very positive guy. We know him personally. And of course, he said, well, I guess I got to go back to work, even though I just retired. So he was a consultant in operations for Ford. He went to Johnson Controls, developed another 401k plan, got that up to about $200,000. Well, then 2008, those of you that remember it, it was kind of crazy. So his 401k, that second one, plummeted again. So it went down to about 60,000. He had never invested in real estate before. Knows that, or knew, I should say, other people that were doing it. He said, if I can run the operations of a Ford or a Johnson Controls, I certainly can do some real estate. He heard about iPlan Group. He associated himself with other people that were winning in real estate, just like you're doing here today. And he was able to open, even with those two funds that he rebuilt, he was able to open a traditional IRA, individual retirement account, and funded it with those 401ks, because now those are former 401k plans. And he was able to fund an IRA with iPlan Group. He went out and purchased 14 properties. Some of those included lease options. Some of those were, buy and hold. It flipped a couple. But he was able to invest in real estate for the very first time using a self-directed IRA, multiple properties, and nearly tripled his IRA in just 6 years. So he went from about 360,000 to over $1 million. Now that's while he was taking those required minimum distributions out of that IRA. Those of you that have a traditional, that required minimum distribution is something that's in place at 70 and a half. Now it's 72 years of age. But he was able to do that and still grow the account. He was able to provide for private care for his wife because she was failing with dementia, and he was retired. And he's still living off of these accounts. Now, I also want to point out real quickly, he holds about, I think it's 7 or 8 properties today in this IRA. He purchased those properties under market by 40%. So when he goes to sell those today, tomorrow, later on, he'll decide that time, he's going to profit again, right? So that equity piece is coming back to him ongoing. Not going to go into the details here too much. IRAs, basically part of ERISA, a legislation enacted in 1974. That's when IRAs came about. 1997, I think, is kind of the key year for a lot of real estate investors that discovered the Roth, because now they knew that they could do things in a tax-free environment versus the tax deferred. But this is where IRAs come from. Have you been able to do self-directed IRA investing since 1974, if you were around then? Yeah, you could have, but most people didn't know about it. It really became a thing more so in the early 80s. Actually, a local company here kind of pioneered it for us. And then I would say probably in the past 8 to 10 years, a lot of people jumping into this space as a provider. It's a big industry. We've got about $28, $29 trillion in retirement accounts. That's including employer-sponsored plans in the US. Out of that, about 160-70 billion is being self-directed IRA. So it's a very small pool, right? Very large pond, right? Small. Every time I go to say that, I don't say it right, but you know what I mean. A lot of people aren't doing it yet.
So Roberta, if you don't mind me asking here, so would you say that the reason why there's such a big disparity is because people just aren't aware? Is that one of the things?
Absolutely. And that's one of our kind of missions, if you will, here at iPlan Group, is really to get the word out. We're not looking to be this huge company and scale and do all these great things. We're a company built by investors for investors. So we know how to win in this space, and we enable other people to do that. So our goal isn't to be the big gorilla, so to speak, but really to enable our clients to do what we know they want to do. Second of all, we realize, and they'll realize this too, it's just like people just don't know about this. And if they did, just like you said, Agostino, you would have been doing it from day one. And not on all your deals, but you certainly would have used this tool.
Well, yeah, I mean, that's one of the things is that, especially when you're starting out, we always have this thing in our heads like, oh my God, I don't have any money. I don't know anybody that has any money, so therefore I won't do anything and just sit by the sidelines. But had I known about this is just like I said earlier, it's another tool in the tool bag. And I could have went to friends and family and said, hey, this is another option. If you're serious about investing in a deal and partnering up, you could actually do a self-directed IRA. I mean, it is a way to do it. So,
absolutely.
Yeah.
And we'll look at some of those mechanics a little bit too, and talk a little bit more about that. But a family of investors. I'm glad that you mentioned family, because this is information that you can bring to, people that your friends and family and trusted people. And now all of a sudden the light bulb goes on for them and saying, well, yeah, I do have funds. We just have seen, oh my gosh, millions of people across the country that have lost their jobs, unfortunately. And here in the state of Ohio, it's also very significant. Well, all of a sudden, those 401k plans that they couldn't really do anything with, those are now available for self-direction. So they're able to invest a piece of the pie, for sure, or into the pie, I should say. You might not have heard of it before because that your financial advisors or other people that you talk to, just like, well, no, I can't do that. I can't invest in real estate with a retirement account. Well, you can. It's just that the other companies out there don't do it. This is our wheelhouse. This is what we do. It's a unique custodial responsibility. We do the compliance review. It's clunky. It's not like a ETF, right? In and out. So we understand it. That's why we do it. IRS.gov website. If you do a little searching on that site, real estate and an IRA, you'll find out that it totally is permissible. It's just that all custodians, they're not required, to offer this. So that's why you don't hear about it. I touched on the SECURE Act, maybe or maybe not. Actually, the SECURE Act came before the CARES Act. CARES Act was the more recent legislation. SECURE Act changed a couple things for your required minimum distribution, like that age 70 goes to 72 now, your required minimum distribution. And also the beneficiary IRA, something important for you to know as well. A beneficiary IRA can also fund a self-directed IRA. And now the SECURE Act says, guess what? You don't get, a lifetime to do that. You need to do that in 10 years. So that's something to know. If you need to know more about that, feel free to reach out to me. The CARES Act, that's the more recent legislation, enabling IRA holders to access funds without penalty. There's also some loan features in place where you don't have to return those funds back to the IRA within 60 days. It can be up to 3 years. So there's a lot behind that. If you go to our website, iplangroup.com, you'll also see a case study, Larry, that I mentioned. You'll see the CARES Act, more detail, so you can read through that. But there's some interesting things there. So if you're questioning that, you want to learn more about that, let me know. Again, as investors, you don't want to raid your IRA. You want to use this tax advantaged account to keep investing, right? If you don't need to live on that money for liquidity, you certainly want to keep it there. 3 different areas of investment that you can do for alternatives: physical property, which we're talking about, but we're also touching on this note investing, right? We're talking about private lending, where you can actually, an IRA can give a loan and it can take a loan. So when you're talking with others and they say, well, I'd love to, invest some money with you, but I don't have any money, but, I've got some IRA money that I want to keep it in the market. I'm looking at different options. This is where you can say, hey, you can create a loan, promissory note, and that can be secured, mortgage backed. And then the points that you charge, if you're going to charge a point or two on that loan, or the interest rate would return back to the lender's IRA, tax deferred or tax free.
Now, hey Roberta, just to expand on that just a little bit, this is a great way that many people actually earn some passive income. Many of the hard money guys and girls you probably know of, even in this community, they make a pretty decent amount of cash just lending out their own self-directed 401ks for people that want to buy a house, flip it, they make money, you make money lending them the money. And yeah. Scott, I know Scott, you do some of this lending too, right?
Yeah, we're hard money lenders, and we get a really good return. It just the lending itself is almost livable.
Yeah, and you're using your self-directed 401k for this too, right?
Well, we've got Roth and SEP.
Yeah. So it works. You do this already, and it works. This is real stuff. It works out great. Yeah,
love it.
Yeah,
and it's easy.
Yeah.
Oh, that's good.
Yeah. Okay, I'm sorry, Roberta. Go ahead. I wanted to really connect it to someone who's actually doing it, because I know Scott does this. So
yeah, I might have some questions for Scott as well as we go. So 7 different accounts that you can use. Scott just mentioned the Roth and the business plan, which I'm great to hear that you're using that. For those of you that are small business owners, there's the solo 401k. If you're owner operated, your spouse or partner can take advantage of the solo 401k. Small business plans, the SEP and Simple, are different based on number of employees and different contribution limits. The big key there is if you do qualify for those accounts, your contribution that you can make to those accounts is much higher, right? Because you're the employer and the employee. So you're doing both ends of that. I mean, you have to make the income to contribute to it, but it's very powerful because now instead of just $6,000 on a traditional or Roth, $6,000 contribution limit, or $7,000 annually contribution limit for people that are age 50 and over. Now, with a solo 401k, you're potentially talking up to $62,000 annually, depending on your age. Also, you can use the health savings account, probably one of the most attractive for those of you that are funding these, but the reason being is you are able to get a tax deduction, right, on the contribution. And then when you pay for a qualified medical expense, it's a tax-free withdrawal. The only thing you need there is a high deductible healthcare plan to qualify to set one of those up. But if you do qualify, you're able to contribute, pay for right now medical expenses as well as long-term. If you know how to grow those accounts, those are super powerful. Coverdell Education Savings Account, good for people that have children, grandchildren, nieces, nephews. The only thing there for the child that you need is a social security number. So that can be started when the child is born, basically, and gets that social security number. This one I mentioned because it can be set up kind of that family investor, right? The young ones can start early, and then these funds can be put into an investment, even if it's 2%, 5%. Our owner did that with her children on a mobile home park. A couple of Coverdell Education Savings accounts were titled in that investment, and she was able to pay for the kids' education when that park was sold. So really powerful stuff. Prohibited transactions and prohibited persons. Main thing to remember here is some of the people that are prohibited to your IRA, one of them is you. And what that means is you buy a house and you title it in the IRA. It's titled in the IRA, but it's your IRA, so you can't live in the house. You would be prohibited to that transaction or that investment. And so anybody up the family tree and down the family tree, ascendant, descendant, is prohibited. Sister, brother, cousin, not prohibited. So that's different. So very few things that you cannot invest in with a self-directed IRA. That would include collectibles, antiques, alcoholic beverages, so like the wine collections and beer collections, that kind of thing, can't do that. Life insurance, S corporations, but very few things that you can invest in with an IRA. Really good to know. I like to point out here too that, you know, with raising funds and capital resources, this is a good thing to keep in mind, where you can partner or co-invest with IRAs. Just like when somebody says, well, I don't have enough cash to buy a piece of real estate, some people will say, well, you know, I only have 20,000 in my IRA, that's not going to do much. You can partner that IRA with another IRA. So while your wife or your husband or your child, son, daughter might be prohibited, right, to the investment, they're not prohibited to partner. Their accounts could partner in a particular investment with you. You can also partner your IRA with cash. You could do that with Agostino, right? Agostino, if I had an IRA and I said, hey, I've only got 150,000 here, but I got 50,000 cash, I could do that with you. I could partner that.
Absolutely, yeah.
So you can partner with other funding sources to, you know, increase capital. We certainly don't have the time today to go into the leveraged debt and all the things that go into that. We can talk about that more individually, but there are situations, and we may see more of this now, where banks are going to be, you know, they've been cautious since 2008, sure, but they loosened up a little bit, but now there's more caution, where there's just more to go through, right? Sometimes you just can't get the deals done. So the ability to have a private lender and financing with an IRA is a way to, you know, cover that base, if you will, to get something done. So non-recourse lending, just keep that in mind whenever you're lending from an IRA, or your IRA has to take on debt. there's no recourse. The IRA itself cannot be the recourse for the loan. Tax advantage choices. How are we doing on time? Okay, pretty good?
Yeah, we're doing all right.
Okay, I'm gonna move through this pretty quickly. This is not about, you know, if you're gonna pay taxes. Most people say I'd never want to, but really it's about when. So are you gonna pay taxes when you have a little bit of money, you've grown it in your investments or your IRA? This is just a real quick example, impactful visual with a single family home. In Cleveland, we know you can certainly in Akron, Canton buy homes for $98,000 and sometimes way less, in this case, $98,000. Let's say you just purchased it at the right time. You titled it in your IRA, traditional IRA, and you sold it next week for $198,000. Now you've just made a profit of $100,000 in the IRA, right? Because it's titled in the IRA, not your name personally. At 59.5, when you're eligible to take that money out without penalty, who's involved? Silent partner, the IRS. So you've got to add that money to your net ordinary income at that time in the year you take that distribution and pay tax on it, whatever your net effective tax rate is at that time. Now, if you make a lot more money, regardless if the tax rates go up or down, it's going to be a big chunk because you've grown the money. Now, let's say you do the exact same thing with a Roth IRA, titled in the Roth IRA. So you make this profit of $100,000. When you're 59.5, you're eligible to take that out without penalty. Well, who is no longer there? The IRS. This is what we're talking about with tax-free growth. Because it's titled in the IRA, you owe nothing. That is not added back to your net ordinary income. That's very, very powerful. That $100,000 that you just made, you will never pay tax on that. So again, you can do this over and over and over. Deploy those funds over and over. There's a book out there. It's called The Power of Zero. You might want to jot that down. Written by David McKnight, and he talks about this tax-free bucket. It's a great resource, quick read. The Power of Zero, David McKnight. I would highly recommend that. One of my favorites.
Now, Roberta, you're also, I mean, aside from doing the single family thing, you can also invest in bigger deals too, right?
Absolutely. And one of those, I like to use that example because it's concise and it demonstrates easily. But yes, take whatever investment, your last investment that you just did, or one that you're in right now, on the exit, you're going to be making money, right? You're going to profit. It's going to be added to your income. You're going to pay taxes on it. Think about that investment if a portion of it was done with the self-directed IRA or 100% of it, especially if it's Roth.
Yeah.
Right. So very, very, very impactful. I don't have this slide today, but one of the ones I throw out sometimes is Peter Thiel, co-founder of PayPal. So he invested with a Roth IRA. He bought shares in PayPal with his Roth IRA. And then when the company was sold to eBay, he profited. His IRA is somewhere in the neighborhood of reported 30+ million. So it's like an ATM machine, right? He literally goes to the ATM machine because there's no tax. Even if you take it out prior to 59.5, it's 10%. It's not added to your net ordinary income. So that's much smaller, right? When can you start investing? This is important. A lot of people say, hey, I love this idea. I'm not really sure what I'm going to do yet, or I'm thinking about this, but you know, the timing might not be right for me. Just keep in mind, whatever you do, you must have an account open and funded before you make an offer, whether that's physical real estate or if you're going to invest into a startup company or private entity, PPM, syndication, whatever it is. That titling has to be right up front. You can't do any kind of consideration in your name because we can't throw that asset or that portion of ownership back into your IRA. So very important. You do not, we have no minimums at iPlan Group, by the way, with funds that you move over, there's no minimum, but you want to be able to have some money there so you can start making the offers. You can always add additional funds. We don't charge extra for incoming and outgoing transactions. So you can always add into that, but you want to be in a place of readiness if this makes sense for you. I touched on the funding a little bit in terms of the contribution limit on the Roth and the traditional. But basically three ways to fund a self-directed IRA. So those of you that are talking to people that have those old 401ks, this is a great thing to keep in mind. Just 3 ways to fund. 1, contribution. So you can start with that contribution. They're very powerful, by the way, if you make them every year. You can also add that contribution in after you've done that second form of funding, which is a transfer. So you do an in-kind transfer, traditional money to traditional. I apologize for the background and I don't know if you can hear it. My daughter left Milo, the dog. So she, can everybody hear me okay?
Yeah.
I should have mentioned in the beginning that I have Milo the dog with me. So I can pull the toy if it gets too noisy. So contribution, transfer is the second way to contribute. Traditional to traditional, Roth to Roth, that is not a taxable event. So people that have existing IRAs, so these are outside of 401ks, right? Those are available to transfer in portion or in full to fund a self-directed. Then the rollover 401k, it's got to be a former plan. In some cases, you can do an in-service distribution or an in-service rollover. That's what it's called. So if we see sometimes that people that are 50, 55 years of age and they're still working, sometimes a portion of that plan is available. So you want to jot that down too. In-service rollover or in-service distribution, but in our case, it would be an in-service rollover. TSPs, pensions, those are available for those people that have them. If you have a SEP IRA, that can also fund a self-directed IRA. You can keep it in the SEP format with us, or you can put that into a traditional. So fees, email number, our form fees, one-time application fee, $50. And very important here for those of you that are doing self-directed IRA investing, you might want to take a look at our fees. Here is that we don't charge a percentage of the asset value or account value. It's a flat capped fee. So most people are probably in that $375 to $500 annually. But let's say you grew your account over $1 million, you'd never pay more than $1,000. So that's a pretty big difference with our competitors, and no transaction fees. So it doesn't matter how many assets, doesn't matter how many transactions. We keep that very, very simple. So why do you want to use an IRA? We've touched on some of this. There is some asset protection in and of itself. An IRA lives for 100 years. It avoids probate and bankruptcy. Investment flexibility, capital resources, those tax-free profits, pretty attractive, in some cases tax deferred. And of course, in the traditional conversation, IRAs, you've got that annual tax deduction. So very powerful. My contact information is here, but I want to, just kind of keep our conversation going. You're welcome to reach out to me with any questions. Certainly would waive any application fees for anybody opening this month, but again, I'm not really here to pump this, but I want to really, answer your questions. So
Roberta, here's a question for you. So let's say, for instance, I currently have a duplex, and I want to expand out. I want to maybe talk to my friends, my family about investing, possibly partnering up on a 12 unit or an 18 unit or a 30 unit or whatever, right? We'll say a 30 unit, and I need to raise 200 grand to buy this $600,000 deal. Mm-hmm. What are the steps I should do to talk to people about maybe using their IRAs or their self-directed IRA to really invest in my deal or the deal that I'm presenting to them? That's probably the better way to put it. And to allow them to make some money and of course build some wealth for myself. Like what would you say would be the right thing to do, the approach, that kind of thing?
Yeah, so I always think the best place to start is just the way that we're starting here too, is through that education, right? So connecting with somebody that like an iPlan group, like Roberta, just have them, give me a call and just talk about these basics. I would share these basics with them. You can go to our website as well and look at the resources to explain the accounts. I think that's like the most important thing. It's important, and forgive me, Agostino, you did say like people that you know, right? People that you're talking to, friends and family. The first place to start is getting educated to make sure they understand. A lot of times I hear people say, well, oh, so in other words, I'm going to make a distribution and then I'm going to give it to you. The terminology, sometimes people trip over it a little bit. So you want to make sure that you're explaining this titling aspect, that the money's staying inside of the IRA, that those the resources are available to you to keep them deployed in investments. You're not taking them out. It's not a taxable event. So it really explaining that process and walking people through it.
Yeah. Well, I think the key though is that you're not waiting till you find a deal.
Yes.
You're always raising money. You're always trying to find you're trying to connect a deal to the cash, and you want to at least start getting the commitments lined up today on where the money's going to be coming from. But even even when I'm doing a 200 unit deal, before I even put the LOI in, I'm trying to figure out where the money's coming from. And that rule has always been in play since I started with my first single family house. I've always thought, okay, if I put a deal on this thing, where am I getting the money from? It doesn't hold me up, but I'm always trying to figure it out. So that's why for everybody on the call today, if you guys are looking to get into a bigger deal like today, eventually, those conversations as far as priming the pump need to be happening today. So that's why get out there, start talking to people. Hey, look, I'm looking to eventually take down a 30 unit property. Here's what I expect is going to happen. Mm-hmm. Do you know anybody who might be interested in partnering with me? And if they say, yeah, I might be interested in partnering with you, but I don't have any money. Well, do you have a 401k? Sure, I do. Well, here's how it would work if you did that, and then you don't have to sell it to them or anything else like that. It's like you tell them a little bit about it, but then, turn it over to Roberta and she can help with getting it ready. So that when you do find that deal, and you will find it, it takes time, then it's easy to just connect that money up and away you go. Right.
Right. Two things I want to mention there is, number one, you can't act on something you're not aware of, right? If you don't know anything about it, how could you possibly take advantage of it? So yes, starting the conversation, keeping people engaged, and kind of dripping right on this alternative way to invest. Second of all, including our founder owner, Jill, she's very active investor. I mean, a lot of times you're dealing with the tenants, toilet, and trash, right? With multifamily, you've got good property management, so it's kind of like a passive investment. So our owner included, she's like, I don't really want to deal with that stuff anymore. Been there, done that, but I understand the power of real estate. They're able to discern a good investment because they have experience, but they're like, you know what? Yeah, I'd rather just give you a portion of my funds from my IRA. You drive it, bring the returns back to me. You take care of it. So that is something to keep in mind, because you're probably talking to people that would prefer that as well. They just don't know.
Absolutely. Does anybody have any questions? And there's no questions.
Oh, you guys know everything.
Well, what I did was I shared, if you guys want to text the word freedom to 202-410-4202, it's put in a chat box. You text that, I can send you a free ebook on how to raise capital as well. And this is one of those things we talk about is using 401ks and that kind of thing. Right. So
hear one question? Did I hear somebody?
Yeah, I have a question. This is Paula. So most of my money is in a traditional IRA. So what are my options for that? Like, is there a way for me to change that money over in some way?
Yes. So the traditional IRA, your funds existing would be able to fund a traditional IRA, individual account, self-directed. So you could bring a portion of that money over or bring that money over in full.
Well, my question is with the Roth.
Okay.
Like, is there a way for me to take that traditional IRA and turn it into that Roth?
Yes, great question. We didn't touch on that. That's called a conversion. So you would be able to bring over traditional funds and then convert the funds to Roth. Now that is something that would be a taxable event, because you see with a Roth, it's after-tax contribution. So when you convert traditional money to Roth money, you have not paid taxes on that money and you're putting it into Roth, right? Because that's tax deferred to tax free. So let's say you're going to convert $50,000 of traditional money to Roth money. The $50,000 would be added to your net ordinary income in the tax year that you do the conversion. So you just have to keep that in mind. people often, check with their CPA, depending on how you're filing your taxes. You pick a time where maybe your tax rate is lower, for a conversion, or you can do it incrementally. Does that make sense?
Yeah, in fact, that's exactly what we've been doing. Is our traditional IRA, the SEP, we've been moving it incrementally across to the Roth. Because we didn't find out about the Roth until after we had done a decent job of funding the SEP.
Okay.
And so that's our process.
Excellent. Yep, it works very well.
And I guess you can also do similar to what Scott has done, where you move it into that Roth, and then next thing you know, you're able to fund certain deals, maybe, or lend it out if you want. Lending it out is a whole business in itself. Actually, so is doing the whole house flipping thing, like in Roberta's example. But that is a great way, if you really, really wanted to help build up that account, so you can eventually invest in multifamily, right? I mean, that's ultimately the goal. That's why we're all here today. But for some people that still need to build up their cash reserve, so to speak, that's a couple of ways of building that up. I would much rather see someone do a flip than try to do what Scott does, because what Scott does, and I'm sure Scott, there's a level of risk involved, and trying to understand like who the person is and who you're lending to, right? That's a whole
right. Well, and it's not for some. I mean, we've been in real estate since 2002, so we've only been lending about 4 or 5 years now. So we already knew what the types of properties that were out there and what their values were. So we had the experience that we could, so that the lending made sense as an add-on to our real estate business.
Great point.
Yeah, and this is a great way to grow that account tax-free. Just an amazing tool. Yeah, amazing tool. Excellent. Any other questions?
I had a quick question. Are you guys like a competitor of Equity Trust? Is it the same type of thing, or are you different?
So yes, we do the exact same thing. The biggest difference is we're a boutique firm. We're a smaller firm. Responsive. That's the biggest difference. Same day processing, no extra fee.
Okay.
Yeah, and I would say that there was a time when we were trying to fund a deal, and we had a gentleman that wanted to come in at the very last minute to throw down $100K on a deal, right? And we had to get them all set up with Equity Trust. That's who it was at the time that we were dealing with. Roberta was working at Equity Trust at the time, but I didn't know her. I was dealing with another gentleman, but and it wasn't him either. That was the problem. Equity Trust is very, very slow to respond. It was a freaking nightmare trying to get that deal closed, because it was all held up by those guys. I'm not trying to slam them. I'm sure they're a good group of people. They're really, really cool. But I think that maybe it was the group that we were dealing with. Maybe there was some other complexities involved. But I think when you're dealing with a large group on something like this, and you're in a hurry, it was a bit difficult. But it sounds to me like dealing with Roberta, they have a smaller team than Equity Trust does, and I think, like she pointed out, you're actually talking to a human as opposed to talking to a machine, which can be rather cumbersome when you're in a hurry. Not that you should be in a hurry. That's all the time, but you get my drift. That's why I say, like, if you know you're going to be doing this, and like this business, you're going to be growing it, you want to buy a larger deal, start getting this stuff nailed down now. Like I know enough about this, how this works, so I'm able to at least speak to potential investors about investing in one of our deals. As a matter of fact, on the Rockefeller deal, someone just put down $100K using their self-directed 401K. So that's how they're doing it. And we started that relationship a long time ago. Now they want to invest, and it's already set up. It's pretty seamless, right? This is one of those things that you're starting this now. You're building up your education today, so eventually you can share this with someone else, and then let them you know, the cool thing is that once you know it, you can let them make the communication with Roberta and you're hands off from there. So yeah, it works out to be very, very well. But as a money raiser, like everybody on this call is, this is just like another tool in your toolbox to go and raise money. Yeah. No other questions? No. All right. So tell me, where are you guys buying deals right now? Are you guys buying up in Cleveland? Are you guys staying down in Canton? Like where are you guys looking generally?
Well, I'm looking for something 20 to 50, Summit and Stark County. Needs upside potential, always needs work.
Yeah.
So that's what I'm looking for, is something that has a good upside potential on it.
Hey Roberta, can you turn off your screen share? Maybe put your contact info in the chat box so people can still reach out to you.
I think maybe you have to take the screen back.
Oh no, Scott.
Oh yeah, Scott. I did stop share.
All right.
The stop share should do. Yeah.
There we go. There we go.
Yeah,
there
it just takes a while. It's video is slow.
Yeah, it's fine. It's fine. And I'm sorry. Who was just Zachary? Was that you
Frank.
talking?
No, that was Frank.
Frank.
Yeah.
Okay. And you're looking down your neck of the woods then?
Yeah, Stark and Summit County. I've been looking recently 20 to 50 units, seeing what's out there. Looking for something, of course, with upside potential. Something that either half occupied or a little bit more, preferably, but something definitely that needs work.
And you think you're going to self-manage that, right? I know you self-manage your stuff right now.
At the moment, yeah. But if it's once it's up and running, I'll definitely turn it over to somebody else.
Yeah.
That'd be the plan. But as far as self-managing, yeah, starting out, of course, to get it to understanding the costs and operation, and then providing a system for whoever's going to run it.
Yeah.
Which I'm in the process of doing now, is creating my own system for what we do here with our properties. So it can be passed on to somebody else. And then, of course, you got to babysit them.
Yeah, that's the thing. I mean, as someone that's managed, I have small deals, I have big deals, and I have everything third-party managed right now. To try to do a small deal, for me, I can't do it. I'm selling all my small stuff. So because I'm just not built to scale like that. Like you pointed out, you're building out the systems. You're probably using say Mr. Landlord's stuff. He's got really good material on self-managing.
Yeah. We have his stuff as well.
Yeah, his stuff is good. And but yeah, you have to define all that and then manage the property manager. But I think the key though is that you're self-managing all your stuff. I know Craig does too, right? You self-manage everything. So that's how you're able to keep an eye on it. If you try to manage a 22 unit and third party manage it, you're going to get killed on it. That's my opinion anyway.
You'll get killed. You'll get killed.
Yeah. Because
we have a small property management company that just does all our stuff. And, we have meetings with the leasing managers once a week and our maintenance coordinator, and it works out well. We end up paying about a little less than $30 a unit into the management company, and then it's on kind of on autopilot right now. As far as buying, we're closing on an 18 unit in Kent on Wednesday. So
nice, good. Yeah, but you have other stuff out there though, right?
Akron, that'll be our first one out there. We've got a lot of stuff in Akron.
Yeah.
So
good.
Our maintenance guys, they can hopefully schedule a day out there once a week or something to clean up any little issues. And we got some emergencies we need to be out there.
Yeah. Excellent. Yeah. And that's the thing. It's like, so I'm a real big believer in staying somewhat local, at least building out somewhat local, and then maybe say 2,000 units, 3,000 units in one area. Once you're able to contain that area, then go to the next area. So I'm not one of those guys. I don't really believe in the whole model of buying 200 units in North Carolina, another 100 units in Savannah, Georgia, and then we're going to go buy another 200 units in Dallas, Texas. That's ridiculous. I don't understand how people do it. I don't get it. It's very, very difficult. My business partner, and he's a really good friend. He's got 4,000 units, but he's got like 1,000 units in Columbus. He's got another 1,500 units in where where is that? And it's somewhere in Louisiana, I don't know, but they're all in close proximity, right? That's the key, is proximity. They have to be close and keep an eye on it. And just as Craig pointed out too, I mean, he does the same thing. You know, everything's in driving distance. You know, he can get to everything. He's got a team of people. So it isn't like he's having to jump in his car and go check on the light bulb. Because believe me, those guys will charge you. The third party guys will charge you $200 to replace a light bulb. I swear to God, I saw that on my. I saw that. So I look at it. I'm like, what the hell is this? So I call, dude, what's up? Why? Well, we have to drive out there to replace a light bulb. Are you serious right now? Really? $200. I would do it for $200. I'll get in my car and I'll drive to freaking Cleveland, or maybe I can just go there next time I'm out there. I'm out there every other day. Seriously. But that's my point, is that try to find something close to home. The good thing about Cleveland, and I know I've studied many markets. This market, for those who are in here or in this market, sorry, Mark, that doesn't include you. So, but this is a great market to still be buying in. It really is. You definitely need to be looking at units. I still say the bigger the better. Don't let the fear of financing hold you up. That is a misnomer. You partner up with someone that has the capability to close, and you give them a part of your deal. Don't be greedy. It's okay. Give up a little bit. It's fine. Think long term. This is a long term play. So I've partnered up with, as I said, a really good friend of mine. Yeah, and he's a good guy. I like him. He likes me. We work very, very well together. And I give up half the deal. Don't care. So that means I have to do 6,000 units instead of 3,000 units to get my target. Okay, fine. Whatever. You'll build up wealth in no time with this thing. It's an amazing business. And he helps raise the capital. I raise the capital, and we both end up rich. So that's what the name of the game is, right? That's why we're all put on this planet. No, I'm just kidding. That's not the reason why we're put on this planet, but it's at least a top 10.
Well, on the multifamily, I've been doing a lot of research as far as on utilities, whether they're self-contained or like with you with one furnace for an entire building.
Yeah.
What do you find to be the most easy to manage or easy to operate? The self-contained ones?
When you say self-contained, you mean like
furnace, water heater, and are in each unit.
Oh yeah, no. I'd always do that all day long if I could. I mean, when I don't have to worry about passing on, or if I can pass on the cost of utilities to the tenant,
sure.
That it's a miraculous thing. They suddenly the water bill is not nearly as high. Yeah. Well, that's crazy, right? I mean, there is one way you can do it though, especially on some of the older C-class assets in a place like the Midwest and in the Midwest in general, right? Mm-hmm. The reason why the split utility does not really exist on some of these older properties here, as opposed to somewhere like, say, on the West Coast, like out there, is because we were built first. As a nation, the Midwest, the East Coast, and then as it swept along to the West Coast, a lot of the older properties, we don't have separate water, right? And we don't have separate heat generally on some of the older C-class assets. So what does that mean? Well, that means that we're stuck paying the water bill. Right. We as landlords are stuck paying the water bill. And in a place like Akron, water is more expensive here in Akron than it is up in Cleveland.
Oh, sure.
Right. A lot more expensive. So the reason why apparently, and Scott, you probably know the history too. I'm sure so do you, Frank. And you guys can fill in the gaps. But as I understand it, years ago, there was some sort of water or some sort of sewage issue or something like that. And the city, I don't know, they screwed something up. And the repair ended up costing millions upon millions of dollars more than what it should have. And they just said, in typical government fashion, okay, we'll just pass it on as a tax. And this happened like 20 years ago, 30 years ago, and it's been the same way ever since. Because one thing the government is not really good at is giving up money after they've got used to taking it. Right? Is that true? Is that some sort of sewage thing? Right? Is that what it was?
Yeah, Akron has a big problem with sewage runoff on heavy rains, which back up into the freshwater area. So they, of course, have to fix that by Fort River. And I look at the bills. I don't pay the utilities up in Akron, but I see them.
Yeah. So
the sewer part is a lot higher than the water part.
Yeah. So the point is that we as landlords got to pay it. So how do you fight that? How do you address that? And one great way is using RUBS, which, Scott and I have been, we looked at doing some software thing years ago, doing a ratio utility billing thing, right? And the way you would do that, though, is interesting. One thing that we do, like I have a property that we pay the water, gas, we pay everything on it. It's a long story. I never got around to putting in RUBS and selling the property anyway, so I'll let the next guy do it. What you're able to do to control the water bill there is insane. It's crazy because they don't care. I honestly think that what they do is when they wake up in the morning, they go over to the kitchen, just turn the water on and walk away just to hear it. It's an amazing thing. But what you do is, let's say their rent is like $600. So you tell them they're up for renewal, reduce their rent to $550 and say, okay, I'm going to reduce your rent to $550. But I'm going to charge you $600 or $50 for water. And so essentially net, it's the same to them. They're like, oh, cool. Okay. But then now they realize, okay, that's a separate line item. So next year the rent goes up, but the water stays the same. Or better yet, maybe the rent stays the same, but the water's going up. Right. You have two levers. And if they know their water's going to go up, they're going to keep an eye out for that $50. They don't want to see that $50 go up. You know what I mean? Because now you separate it out to two. So net is the same, but it's a psychological trick that you can play, which I shouldn't say a trick, but it is psychological. Let's be honest here. That's what it is. So, but what it does is it allows them to keep track of the water. They're keeping an eye on it, and they don't want to see that water bill go up for them because now you're controlling the lever on it. So there's that now, and there are certain cities where RUBS is not permitted. Like Cleveland, you can't do RUBS, but you can charge a fee. It's different, apparently, right? So, it's fine. I actually saw that someone is doing that because we were going to do RUBS on an asset up there, and they, the attorney advised as well, you can't do RUBS. I'm sorry, it wasn't the attorney. It was my property manager said, oh, you can't do RUBS. It's illegal. But yet these guys are doing it. So I get a hold of their lease agreement. I send it over to my attorney. He's like, oh no, they're set this up as like just a side fee. It's a fee. It's technically not RUBS. They just called it something different. So definitely a way to get around that stuff in some of these older assets that like the majority of us, if not everyone here, is getting into, especially here in Ohio, is knowing those little tricks will save you. God, could save you. It could actually, if you do it right, could increase the value of that asset tremendously, especially on a refi. It's remarkable. So, and I may even do that on one of my assets. Actually, now that I think about it, we bought an asset last year. We're able to we improved its performance. We redid a bunch of units, improved the performance, revitalized that asset. We improved it. Now we just got a refi for $1.4 million more than what we paid for it. Amazing. So we're doing that now. So it's going to be a very good day for me when I get that check. Looking forward to it.
All right.
Agostino, we also we found a company that does remote metering for water.
Oh, Guardian? Is it Guardian?
Yeah, it's Guardian.
Yeah,
so
yeah.
On the toilet and the hot water tank, and then they'll take the bill and divide it up and provide a bill for each tenant.
Yeah, and that's a great tool. Yeah, I forgot about those guys. That's a great tool because they quote take on the risk, so to speak, because many cities I think if anybody's on Facebook, you guys have heard about all this rent forgiveness communist nonsense that's floating around out there. It's ridiculous if you ask me, but and many of those activists are really pushing up against that whole ratio utility billing thing. But you know what? Guardian, they know their way around it. That's a great one. I think there's another one too that's also popular, right? I just don't know their name, but yeah, Guardian's great. Guardian Super. But they won't, you know what though? They won't do it in Cleveland. They just won't even do it because it's RUBS, right? So that's where you get your property manager to do it. Like you basically set up this whole fee type scenario to get around it. Yeah, that's how it gets done up there. Yeah. Cool. Any other questions you want to hear me rant about? I'm really good at this. I could rant all day. No? All right. Well, I put in the free ebook in the chat box. So if you text freedom to 202-410-4202. So definitely, yeah, check that out, guys. And then if you guys follow the podcast at all, so we were doing a one podcast per week release. We're now updating it to like 3. So I'm going to be super, super busy. I'm going to be doing like 3 podcasts a week. It's going to be insane. So that's coming out this week or next week. Yeah, next week. So if you guys want to get your fill on mindset, we talk about mindset, we talk about multifamily, we talk about real estate stuff, we talk about making money. Definitely check that out. So do that. And we're also doing on the 14th, I think it is. We're doing another. I'm doing one of these. Yeah. So on the 14th, on May 14th, there's a Bulletproof Cashflow event, and I'm going to have a guy named Gene Trowbridge on. Now, Gene, he sets up the syndications for guys like Grant Cardone, for guys that have done thousands of units. So he's going to be on. He does our stuff, right? So he's a friend. But definitely check that out if you're not. So when you sign up for that free ebook there, I'll send out an email to that whole list, so you guys can sign up for that too. So if you want to learn about syndication, he's a guy that you definitely want to listen to. He's great, because you're going to need to do syndications and do it right, so that you don't get into trouble, to take people's money and invest it in your deals. So if you want to if you want to scale it from a duplex and eventually get into big deals, yeah, you're going to need to syndicate. Anytime you take money from anybody, you need to syndicate your stuff. So, and as I said, Gene is the best, and he definitely knows what he's doing. So definitely check that out. So we're doing that one, and I think we got another event with the RIA on the 26th, I believe. So Connie will be sending out information on that one. I don't have any information on that one just yet, so I just know I'm speaking there. That's it. Cool, excellent. All right, so no other questions or anything else like that? No. All right, well, let's connect. Please don't forget to do that. Text that freedom to that number, and we'll get it rolling.